Hi, my name's Laura Foll and I am the co-fund manager of Lowland Investment Company. Firstly, probably worth addressing that this is clearly not the office. I am currently working from home along with a lot of the country, but aside from that, it is very much business as usual. I can trade from home, I can see all of the performance just as I could in the office, and me and James, who I co-manage the fund with, are in constant communication. I can still have all of my company meetings, they've just become conference calls instead. So aside from the fact that I am basically working from my home, and you can see a lot of toddler junk in the background if you look closely, everything is exactly as it would normally be. But I thought it was worth addressing some questions that we've had about performance, about how we're seeing the market at the moment, and about how we're positioning the fund. Also a bit of an update on dividends in the UK. So firstly, just for the market as a whole, the market is really grappling with the fact that there are three issues happening at the same time. The first is a supply side shock that happened first of all in China, then northern Italy, and is now really happening on a global basis. And if anything, China is easing with some of our factories or some of our companies that have manufacturing facilities telling us that those facilities are now open, but effectively facilities elsewhere are now in some cases being shut. So there is a supply side disruption happening. The second factor is a demand side disruption that is happening, for this reason, for the fact that people are sat at home, not going to the shops, not going out and buying a coffee, whatever, and also businesses are curtailing spend wherever they can, really. So for example, if they were going to buy a piece of capital equipment or maybe move to a new facility, they are now probably trying not to do that. They'll also be curtailing marketing spend or advertising spend, and also where they can, we are seeing quite a few companies cut dividends, suspend dividends, and I'll go on to talk a bit more about that. So those are the first two: supply side shock, demand side shock. The final factor is an oil price shock that happened a few weeks ago, with the oil price declining substantially after OPEC didn't reach an agreement and then Saudi increased their production. So all of these three factors are happening at the same time. So what you're seeing is the market grappling with that and going through company by company, trying to work out what the effect will be. And that's quite complex, obviously, because for each individual company, there will be a number of different factors happening. And what we're finding is that companies that we spoke to even 2 weeks or so ago, we are now feeling out of date on and are having to speak to again. So things are happening very quickly, and we're just trying to keep on top of that. What we are expecting is that there will be a substantial earnings hit for this year. And I think that's well known, I think that's well understood. Really the focus for us now is thinking about companies where the balance sheet will be an issue. So when I'm talking to companies at the moment, the focus is really on what the cash position is, how much headroom they have in their borrowing facilities, and what levers they can pull on cash to really get out the other side. And there are some companies where they're in quite a comfortable position. A lot of companies learnt the lesson from the financial crisis. In some cases, it's even the same management team in charge, and they therefore ran the business in a very conservative way, whereas others are more problematic. And we're just going through company by company at the moment. In terms of the performance, it has been a difficult time for Lowland. Lowland has a substantial weighting in both industrials and financials, and has done for quite a while. Naturally, when people are talking about the possibility of a global recession, it is difficult in industrials. And really, the industrials that we hold, we think are very good quality engineering companies that should be capable of making very good margins in a better economic environment. Therefore, we are not reducing these positions. If anything, we are adding to them and keeping in contact with those companies. The financials that we hold are largely insurance companies, which we think will be relatively well insulated from this economic effect. So if anything, and we don't hold a substantial amount in banks, we would hold less than the index in banks. So we're quite comfortable with how we're positioned, but that is impacting our performance at the moment. Just to touch on dividends quickly, we are seeing a number of dividend cuts. This so far has been relatively insulated to those sectors that are directly impacted by the virus. So for example, anything exposed to travel and leisure has tended to cut its dividend. Anything in retail, so for example Shoe Zone, which we hold, which is the shoe retailer, has suspended its dividend. We really think that's the right decision, and we are happy to support companies with that. We are a long-term investor, and if that's what they need to do to preserve cash, we are happy to support that. It does, however, make it more challenging managing an income fund. What I would say though is that Lowland has substantial revenue reserves that we've built up for many years and haven't touched since the financial crisis. So 2010 was the last time we used it. So I think we are in a good position as regards reserves, but it is undoubtedly going to be a difficult year for the underlying dividend income. And I think there will be more dividends to come. Finally, just what we're doing in terms of the portfolio. Anyone that knows our style knows that we are very much long-term investors, therefore the trading activity has been relatively subdued, but what we are doing at sort of around the edges is adding to companies that we know very well, have been following for a long time, where we think the valuation is reaching very attractive levels. And the natural question might be, well, how do you know? Because what are the earnings going to be this year? And that's a very reasonable, logical question to ask. The way we're valuing these companies is often off historic book value or historic sales, that we think there is no reason that these companies are structurally impaired, that they can't go back to making that in future. So that is how we are valuing these companies. We are tending to add to companies that we know very well rather than taking new positions. And in order to fund that, we are tending to reduce those companies that have held up comparatively well in this environment. Thanks.